Are you ready for the FOMC? What a day we had, this huge pump, almost 300, exactly 300 points, 1.5%, more than 1.5% for the Nasdaq after the weaker CPI. The strange thing is that everybody was expecting the weaker number. I don't know why market overreacted like that. Anyway, all eyes now on the Fed plot released in the top of the hour, and then after half an hour we have Powell explain us his views. Let me try find him live to be ready. Okay.
Protection and fair lending laws while promoting local community development and lending to depository institutions to ensure crucial
okay, they have one educational video explain us what is FOMC.
Another primary Fed function, fostering.
Okay, I closed the volume. Actually, it's too early to have Powell. Okay, it's in 1 hour. Okay, now regarding what else affects, we had this huge pump in euro, cable, all the dollar crosses, it was normal. We see dollar now trying to make a base here exactly to the support. Let's see, we are getting ready. Pretty boring until the decision, and after that I see the volatility coming. Usually market makers, as always, try to clean the books to the upside and the downside. I believe we're gonna see another attempt higher, at least initially, until Powell speaks. I don't know, it's very common in all those meetings. Yes, I will. Precious metals, gold actually. Okay, this is the chart in gold. I had this morning this bullish bias in gold. Some of my traders in the private Discord group that we have were long. I gave them the 2341 as resistance. And exactly after the news, exactly to the peak, we had the big reversal lower, almost 2100 pips, and then gradually we have had gold going higher. Okay, now silver, one of the same with bigger volatility. I don't like silver. As we speak, we see. Okay, after the initial spike above $30 again, we have now the drop. I don't like silver, especially if China stops buying gold. Imagine what will happen to silver. What else you want to see until the event starts? We have 20 minutes. The chart is yours. AMA, ask me anything. TLT. Okay, I will use the 10-year bond future. We saw the big spike higher, didn't make a new high after the news, but gradually we have had a retest of the high. We saw a little ticks higher and then a reversal lower. I believe yields are going higher again. There is no reason with inflation at 330 to have rate cuts. Come on. Okay. Okay, I believe nothing has changed. I was expecting this retest of the moving average 200. 425 was previous resistance, now acting as support. I see another move higher the next weeks towards 5%. Crypto is interesting because it was struggling yesterday. Okay, today we saw this pump after the CPI. But what to say, I see that there is no momentum left. Okay, maybe we see this continuation today, especially if Powell is a little bit dovish. But who cares about Powell? Bitcoin seems to be making another top at 72,000. Maybe we break, this is my scenario, to break, make a new high and then quickly reverse lower. Same for the Sol, lagging a lot. Ethereum as well, lagging a lot. This is not healthy bull market, guys. Sorry to disappoint many of you. Not to mention about altcoins. They are 70-60% below last month level. Cable, what to say about cable? I wanna see another retest of 128, and if stays above, then might continue higher. Else, also don't forget that cable is having the elections ahead, and also there are some rumors that the fiscal plan of Sunak is not working again. And this will create turmoil in the cable. Now they're having their moments. They forgot everything. They forgot, like Euro, forgot the elections that are coming in France and all the turmoil after the European elections that we had last Sunday. Okay, pretty much it was expected, this move higher. I gave it to my group this morning, this buy. I said buy the dips, cable as well. It was a little bit obvious. Okay, I was expecting to close at least the gap and stay at 10.30. We almost hit 54, another crucial level, but I have marked. And currently retracing a bit, someone is taking profit ahead of the Fed. This is normal. Same situation we see in the indices as well. The DXY is the same, the opposite of Euro. We hit this important support. Okay, this move is a little bit brutal, to be honest, but currently we are sitting above 200 days moving average, and also this cluster of this zone has been given support for the dollar. I believe as long as trading above 104, okay, it's 40 ticks, it's not close, but dollar is gonna have another attempt higher. Let's see. suddenly we forgot everything and we focused on the 0.1 versus 0.6 inflation numbers. Big deal. Inflation is sticky. Okay. We see 3.4, 3.3, big deal. 3.6, 3.4. Okay, we missed for 0.1 percentage of the forecast, but everybody was expecting this drop. But it's still 3.4%, guys. What to say now? I don't know. Europe is 2.5%. It's just algo trading. Okay, let's go back to the NQ. 5-minute chart. 12 minutes to go. This is opening rates from today. We are consolidating above. This is bullish. And also you have a stop 480. Also it's a VWAP. As long as trading above the opening range, it's safe for the bulls. If we enter inside, then things will get tricky. Yes, oil is a the biggest factor that affects inflation, and it was 6%, 7 I think in May, lower. That's why they expected a little softer inflation. Okay, it was rising all morning. After the news we saw this drop. Strange. Currently rising again. I think the correction at current levels is ending. We didn't test another time the $68. So I see this gradually going higher. I still believe we are gonna see 90-100 level during this year, and you understand what inflation pressures this will create. Gold. China news regarding selling gave this big drop. I believe we are consolidating. I'm gonna see continuation towards my target. It is 2268 many weeks ago defined, but remains to be seen. Okay. Yes, Powell is trapped. He cannot be dovish, he cannot be hawkish. He will say the usual data dependent. I believe the Fed, the dot plot will give us more details. But even this is crap. They couldn't predict the inflation 2 years ago. They said inflation came out of nowhere, and now they are predicting with the dot plots each month, each semester after 2-3 years. Come on, it's a joke. But okay, it is what it is, and algos are programmed to trade based on that data. I said today I'm not gonna trade the NQ. That's why I'm not also gonna trade. Okay, I have one small position, another account, but big deal. Less than 9 minutes to go. Let's go. I'm gonna put some music. because you don't wanna hear me singing, of course. So today the bias I have for the Nasdaq is to see a spike higher, to take stops and then quickly reversal lower. I wouldn't be surprised to see anything, of course, not even a drop below 19,000. Okay, just 2.5%, less than 2.5% from current levels. I don't know, this is overstretched, this rally is due to 5-6 stocks. Of course, the queen is Nvidia and Apple. Big rally those days. So if someone wanna take some profit there, it's very vulnerable. Most of the stocks, I think I saw a post that said the new 52 low stocks of the year are more than those that are making 52-year highs. This means that market has no breath, as it's called. It's just Bitcoin is giving some boost right now. I don't know, can you hear me because I get some disconnections? I believe you can. No. Short the laggards, long the leaders. Welcome all of you. I see some new people here. We do this in daily basis in the US Open. We play this opening range system that I have developed. Okay, it's not something new. There are a lot of versions of this opening range system, but I have one mine. What else? Yes, because there is a Fed, I delayed the open until now, so we cover live. I don't believe there are a lot of live trading channels in YouTube that are covering those events live. We also covered live the FOMC last Friday, ECB of course, and today FOMC. So if you are new here and you want to participate, you can like and subscribe and put notifications on, of course, to be notified when it's live. We also have Twitter account. You can find the link in my channel description. But most of you are found me from there, so you know my channel, my Twitter account. Okay, less than 5 minutes. What do you think, guys? What are you expecting? Write me in the chat. I know Victor is bullish. Okay. What about the rest? And there is also one big bear. Who is it? I don't see this perma bear guy. Maybe he's here. Okay, so most of you are bullish in stocks. Okay. Okay, pump and dump. Yes, I agree. I see this move. I said it. It's common. Market makers like to take the stops in both directions before any big move. More upside to you. Godiva, yes, where is Godiva the Bermabero? Govinda. He's hiding today. Okay, I'm bear too, but I cannot but see the momentum higher. So, what to say? This doesn't change anything. But I don't expect this catastrophe that some expect, 50-60% correction. No way. They are not gonna happen. They are not gonna let this happen. If he's Davis, I don't believe we are gonna have a dip. Davis mean that rate cuts are coming, so more pumps. But to be honest, why to have a rate cut if market is at all-time high and cannot show signs of weakness? Everything is good in the stock market, and Fed is what is all about, what he cares. It's all about the stocks. If the stock market is well, everybody is happy, so everything is good for the Fed. Okay guys, it is time. 1 minute left. Yes, trying to pump. Big news coming for the yen on Friday, but okay, we are gonna talk in another video for this. Let's focus on the Fed now. And here we go. Whoa, what a move.
Order filled.
Whoa. Probably we didn't have a Davis plot. Now I have to manage positions. Okay. Fed is gonna release a new forecast today. Okay, I'm trying to see the news if we had something. Okay, the initial spike faded. Yes, one cut that was expected. Okay. Greg was saying this when everybody was expecting 4 or 5 cuts. Stocks again at the initial level.
Order filled.
Let's see. We initially dipped inside the opening range, quickly found support and currently above exactly where it started when the drop started. And here we go again. Of course, big volatility now. The algos are getting crazy. Now Powell will have to explain why only one rate cut. This might be heard as hawkish, as not dovish at least. Okay. The dot plot shows only one cut. This is more hawkish than expected or less dovish, you can call it. Whatever you want. It's getting interesting. Now trying to stay inside the opening range. Okay, it is a little bit wide opening range. It is unusual to see 100 points opening range, but okay. Oh, it's boring now, 20 minutes until Powell gets back in action. I think I'm gonna go grab my second coffee. Market doesn't wanna stay lower. Yeah, I believe that even if it's hawkish Powell, market is gonna focus on the 0.1 inflation miss. Okay. What else? I said gold, my target is 2262. Okay, not for today, but let's see. It's getting interesting. Very interesting. Now I'm in a big dilemma what to drink: whiskey, rum, coffee, cola zero. Water is out of the question. Coffee, it's 9 o'clock here. Okay. For sure no alcohol. And here we go, market's pushing higher. Push it, baby. Give us a new high to go short again. Nothing can stop this market. Don't forget, we have had 0.1 less inflation. Who cares about rate cuts on the Fed? We focus on the inflation. Okay. Okay, let's see. I'm coming back in 5 minutes. Coca-Cola Zero. No alcohol yet. Getting ready for the J. Powell. Yes, Red Bull would be a nice choice. I don't have. Okay, coming. Okay, we are ready. JP.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance with continued strong job gains and a low unemployment rate. Inflation has eased substantially from a peak of 7% to 2.7%, but is still too high. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressure. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.3% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, grew at 2.8% in the first quarter, nearly as strong as the second half of 2023.
Okay.
Growth of consumer spending has slowed from last year's robust pace, but remains solid. And investment in equipment and intangibles has picked up from its anemic pace last year. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2.0% over the next 2 years.
Okay.
In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 218,000 jobs per month in April and May, a pace that is still strong, but a bit below that seen in the first quarter. The unemployment rate ticked up but remains low at 4%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market have returned to about where they stood on the eve of the pandemic, relatively tight but not overheated. FOMC participants expect labor market strength to continue. The median unemployment rate projection in the SEP is 4.0% at the end of this year and 4.2% at the end of next year. Inflation has eased notably over the past 2 years, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in April. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The
Stocks
consumer
doesn't
price
wanna
index,
go
which came
lower.
out this morning and tends to run higher than the PCE price index, rose 3.3% over the 12 months ending in May, and the core CPI rose 3.4%. The inflation data received earlier this year were higher than expected, though more recent monthly readings have eased somewhat. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.6% this year, 2.3% next year, and 2.0% in 2026. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As labor market tightness has eased and inflation has declined over the past year, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks.
Inflation risks. This is
It will be
hawkish.
appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. The most recent inflation readings have been more favorable than earlier in the year, however, and there has been modest further progress toward our inflation objective.
I don't hear him being dovish at all. On the other hand,
inflation is moving sustainably toward 2%.
I see a small hawk.
We know that
His
reducing
heart.
policy restraint too soon or too much could result in a reversal of the progress that we've seen on inflation.
Ooh,
At the
very
same
hawkish,
time,
guys.
Reducing policy restraint
What
too
the
late
fuck?
or too little could unduly
What is
weaken
Market
economic
doing up here?
activity
He's
and employment.
ultra hawkish.
In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data,
Well, of
the
course.
evolving outlook, and the balance of risks. In our SCP,
Give us the
FOMC
flash now.
participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.1% at the end of 2025,
No, he speaks good
and
English.
3.1% at the end of 2026. But these projections are not a committee plan or any kind of a decision. As the economy evolves, assessments of the appropriate policy path will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation
Look
persists,
how
we're prepared to maintain
well
the
and
current target
accurately
range for the federal
my
funds rate
system
as
of the
long as
opening range
appropriate.
holds.
If the labor market were to weaken unexpectedly, or if inflation were to fall more quickly than anticipated, we're prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate.
Oops.
We'll continue to make our decisions meeting by meeting, based on the
Meeting by
totality
meeting.
of the data and its implications for the outlook and the balance of risks.
Okay. He's turning a little bit.
The Fed has been assigned 2 goals for monetary
He's pushing
policy:
the brake.
maximum employment and stable
Let's
prices.
see.
We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the long run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals.
Okay.
Thank you, and I look forward to your questions.
Okay.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Just wondering if you could walk me through the committee's average inflation forecast. Core PCE is now forecast to be 2.8% by the year end. It's already 2.75, and after today's number, there were several forecasts on the street that it would be 2.6 at the end of this month. Does that tell you that the average official expects no further progress in inflation, and in fact that it's going to get worse? And if you have this wrong, doesn't it mean that you could have wrong the outlook for rates there?
Yeah, so what's going on there is that we had very low readings in the second half of last year, June through December really, and we're now lapping those. So as you go through the 12-month window, a very low reading drops out and a new reading comes in. The new reading gets added to the 12-month window. So it's just a slight element of conservatism that we're assuming a certain level of income.
Market cannot hold it down.
PCE and core PCE numbers. We're assuming
Okay, give us a new
good
high.
but not great numbers.
Take
And
the
if you put
stops.
that on top of where we are now, you get a very slight increase in the 12-month reading. Now, do we have high confidence that that's right? No, it's just a kind of conservative way for forecasting things. If we were to get more readings like today's reading, then of course that wouldn't be the case. So it's just a forecasting device. I think. Let me say that we welcome today's reading and then hope for more like that.
But if it comes in, just to follow up, it comes in the way you forecast it, it would seem strange for you to be cutting rates at all in context of a rising core PCE. Thank you.
Oh.
Yeah, no, I mean, I think what we said is that we
Tricky
don't
question.
think it'll be appropriate to
You put him in the
reduce
wires.
rates and begin to loosen policy until we have more confidence that inflation is moving back down to 2% on a sustainable basis. And that's the test.
After 2 years.
I don't know that. I think I don't know that this rules that in or out. I mean, really, it's a
He pushed him.
forecast, a fairly
He pushed
conservative
him
forecast
in the
month by
to the
month
wires.
that would lead to slightly higher 12 months rates by the end of the year. If we get, better ratings than that, then you will see that come down or remain the same. If you're at 2.6, 2.7, that's a really good place to be.
Tirameus.
Nick Tamaros of the Wall Street Journal.
Tirameus.
Chair Powell, if I look at the rate projections, I see 15 of the 19 that are anticipating either one or two cuts this year, fairly evenly split between the two. And so I wonder if you could explain a little bit more the nuances of the differences there. Would 2 or 3 more inflation readings, like the one that we saw this morning, make a September interest rate cut possible?
So as far as the SCP part of that is concerned, as you know, I talk to all of the other participants on the FOMC every cycle, and we talk about their summer of economic projections and the dot plot, their dot plot and everything. And what I hear and see is that people are looking at a range of plausible outcomes, and in many cases they're thinking, I can't really distinguish between two of these. They're so close for me. These are very close calls, but we ask them to write down the most likely one, so they do. And I think as you've said, there's 15 of the 19 are kind of clustered around 1 or 2. So I think I would look at all. I look at all of them as plausible, but I look at I think that does tell you kind of what the committee thinks. But what everyone agrees on is it's going to be data dependent. No one brings to this or takes away from it, that is on the committee, a really strong commitment to a particular rate path. It's actually just their forecast, and it's a combination of their forecast and their own reaction function. But again, everyone would say that this is very data dependent, and I don't hold it with high confidence. And I think if you're looking for and don't really think that they're not trying to send a strong signal that this is what I think is the right thing. It's just what they think at a given moment in time, subject to data. In terms of future meetings, we haven't, we don't make decisions about future meetings until we get there. I think in terms of what we need to see, I mentioned it earlier, we want to gain further confidence. Certainly, more good inflation readings will help with that. I'm not going to be specific about how many because, really it's going to be not just the inflation readings, it's going to be the totality of the data. What's happening in the labor market, what's happening with the balance of risks, what's happening with the forecast, what's happening with growth. You look at all of that and you ask, are we confident, have we reached an appropriate level of confidence that inflation is moving down sustainably to 2%? Or alternatively, do we see really unexpected signs of weakness in the labor market that would call for a response? Which is another thing that could happen. But again, we don't see that. And we see today's report as progress and as building confidence, but we don't see ourselves as having the confidence that would warrant beginning to loosen policy at this time.
And if I could quickly follow up, did you or any of your colleagues change your interest rate projections after 8:30 or whenever you got the inflation numbers?
Good question.
Today.
So this happens too often, but it does happen. It just is, data came, I think it happened a few meetings ago. So when that happens, when there's an important data print during the meeting, first day or second day, what we do is we make sure people remember that they have the ability to update. We tell them how to do that. And some people do, some people don't, most people don't. But I'm not going to get into the specifics, but you have the ability to do that so that what's in the SEP actually does reflect the data that we got today to the extent you can reflect it in one day. I think we'll see PPI tomorrow. We'll know more about the PCE reading as the month goes on, but the initial CPI reading and its kind of first level
He's kicking
translation
the data
PCE
tomorrow.
we did have this morning.
PPI.
We were briefed about it.
Everybody is
People
going to
were
focus on the
consider,
PPI
whether they
once
should make
again.
changes. And as I said, some people generally do, but most people generally don't.
John Allen.
Hi, Chair Powell, Janelle Marte from Bloomberg. As you noted, the labor market is now in many ways back to where it was before the pandemic. I wondered if you could comment on how officials are viewing that. So do you think that there still needs to be more cooling in the labor market to bring inflation all the way down to 2%? Or is there any sense that maybe the labor market is more vulnerable now to higher rates now that many of those imbalances have eased?
Sure. So by so many measures, the labor market was kind of overheated 2 years ago, and we've seen it gradually move back into much better balance between supply and demand. So what have we seen? We've seen labor force supply come up quite a bit through immigration and through recovering participation. That's ongoing mostly now through the immigration channel, but still we've had some increases in prime age labor force. In terms of on the demand side, we've seen quits moving down. We've seen job openings moving down. We've seen wage increases moving from very, very high levels a couple of years ago back down to more sustainable levels. We have seen unemployment creep up now 0.6 over the course of a year or so, very, very gradually. So you put all that together, what you have is still low unemployment, still 4% unemployment, historically low. But it's moved up a little bit, it's softened a bit, and that's an important statistic. But more than that, you've got strong job creation. You have payroll jobs still coming in strong, even though there's an argument that they may be a bit overstated, but still they're strong. So that's what we see. We
Look
watch
how
the
the
labor
opening
market, of
range
course,
high
and the
holds.
economy
It's impressive,
as
guys.
a whole, but the labor market very
Impressive, really
carefully,
impressive.
and that's what we see. We see gradual cooling, gradual moving toward better balance. We're monitoring it carefully for signs of something more than that, but we really don't see that.
As a quick follow-up, the surveys that make up the jobs report are showing different tales. There's been some divergence, especially we saw in the last report that we got on Friday. So how do you interpret that, and how does it change your view on the labor market?
So sometimes you can't reconcile the differences. You just have to look at it and try to understand. And that's why it always makes sense to look at a series, in 3, 6, and 12 months of things rather than just one report. But you're right to point to the last report where there were job losses in the household survey, job gains, big job gains in the establishment survey. So, we're left with ambiguous results, and we have to deal with that uncertainty around data. Nonetheless, the overall picture is one of a strong and gradually cooling, gradually rebalancing labor market. Job openings, while they've come way down, are still greater than the number of unemployed people. The jobs workers gap is still a significantly positive number, greater than it was before the pandemic. So overall, we're looking at what is still a very strong labor market, but not the superheated labor market of 2 years ago, or even 1 year ago.
Thanks, Chair Powell. Neil Irwin with Axios. Back on the rates path, the SEP showed quite a large shift of rate cut expectations relative to March. That's a period in which the economic data flow hasn't been that dramatic a shift. Can you provide some color on what changed in attitudes on the committee over the last 3 months to see a much shallower path of rate cuts this year?
Yeah, the big thing that changed was the inflation forecast. So the inflation forecast moved up several tenths for the end of the year. And as I mentioned earlier in the, what did we take away from this? We had really, really good inflation data in the second half of last year, then kind of a pause in progress in the first quarter. And what we took away from that was that it's probably going to take longer to get the confidence that we need to begin to loosen policy. So the sense of that is that rate cuts that might have taken place this year, take place next year. There are fewer rate cuts in the median this year, but there's one more next year. So you really, if you look at year-end 2025 and 26, you're almost exactly where you would have been. Just it's moved later because of that progress. Now you get different data today. So we'll have to see where the data light the way. We're at
blah 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 data blah blah blah.
Forecasters in both directions, and today was certainly a better inflation.
I think it's
report than
better
almost
to
anybody
sniff their nails, as we say in
we'll have to
Greece.
see what the
Or chew some
income data flow
leaves like
brings
Pythia.
and how that affects the outlook and the balance of risks.
To see the future. Come on now.
Gina Smiler, New York Times. Thanks for taking our questions. In the summary of economic projections, the long-run interest rate forecast moved up a bit. I wonder if we should read that as a sign that you think that policy is not sort of as restrictive as we previously expected. How should we interpret what that means about how the committee views its current policy setting?
So two things about that. One,
Because
one
I'm
is
Greg.
this. You're right, it did move up, but I want to remember to
Really?
point out that
thank
long-run
you.
Neutral rate of interest is a long-run concept. It really is a theoretical concept.
You see, my
Can't be
system
directly
is
observed, and what it is
too good.
the
Look
interest
how
rate
well
to hold the
it's
economy
holding
at
and
equilibrium,
respecting the
maximum
opening
employment
range.
and price stability for
To the
potentially
peak.
years in the future where there are no shocks. So it's a little bit. It's not something we observe today. Today we've got a very specific
You
economy with all kinds of
have to
shocks
try
we're still
the
getting
moving
over
average
from the
here
pandemic.
at
So
27.95. And we see.
I don't think that the concept of R-star is a very important concept in economics and in what we do, but honestly it doesn't really get you where you need to be to think about what appropriate policy is.
All
in
is
the
at
near
a
term.
crucial level.
But
If we break here,
back to your
we're
original
going
question
to the figure.
people have been gradually writing it up because I just think people are coming to the view that rates are less likely to go down to their pre-pandemic levels, which were very low by recent history measures. Now we can't really know that. That's an interesting dispute and discussion to have now. But ultimately, we think that things like the neutral rate are driven by longer run, slow
Okay, let's see
moving
this
forces.
time another attempt
And,
to the
there's a
opening
really
range.
good question about whether those really have changed or whether instead rates and the economy are experiencing a series of persistent but ultimately temporary shocks. That's been the debate, and we can't know. But in the meantime, we're making policy with the economy that we have, with the distortions that we have, And I also, to your other point, I think it is the case that as time has gone by, the question of how restrictive is policy has become one that everyone's asking, and we're asking it too. And my answer has been the policy is restrictive. The question of whether it's sufficiently restrictive is going to be one we know over time. But I think for the reasons I talked about at the last press conference and other places, I think the evidence is pretty clear that policy is restrictive and is having the effects that we would hope for.
Well, thanks to your pal Howard Schneider with Reuters. Just to carry that a little further, should we read this as a conclusion that the combination of tipping to one cut this year and acknowledging further progress on inflation as kind of a mark to market on the level of restrictiveness that you need, that you in fact have concluded that you weren't quite there yet?
I'd be reluctant to try to draw that conclusion. I think this is about looking at the incoming data and asking how much progress are we making on inflation and how is the rest of the economy doing? Is the labor market still strong? That's what we're thinking about. You can translate it into the language you're talking about, but to me the focus is more on we have a goal which is price stability, another goal which is maximum employment. How are we doing there? We think we've got a good, strong labor market still. We think we've been making progress toward the price stability goal, and then for a while there was a pause, and we look at today's thing and we think, well, that's a good reading, and we hope we get more like that. And in the meantime, we're asking, is our policy stance about right? And we think yes, it's about right. We're prepared to adjust it as appropriate, but we think we're getting the things that we would want to get, broadly speaking. And that's why we've been at this policy right now for almost a year.
So just to follow up on that, I think one curious thing here is you've got now this restrictive policy in place and virtually no change in any of the major things for all of this year. You've got growth that stays above long-run potential throughout the forecast period, unemployment that never goes above the long-run estimate, right, of 4.2. So this isn't a story of slack improving inflation. So where's the improvement in inflation coming from that it's going to pick up pace so much in 2025?
Well, it's been coming. Where's it been coming from? We'll start with that. Clearly, a lot of some of what we've been getting is just the reversal of the unwinding of the pandemic-related distortions to both supply and demand, and that is complemented by and amplified, supported by restrictive monetary policy. So those two things have been working together. We've also had a very positive supply shock on the labor side, and also you get a positive supply shock when the supply conditions unwind and return to normal. So you've had above trend potential growth and high growth, and yet you've had the benefit of inflation coming down really fast actually last year.
Look
and
how
we'll see what
well for another time holds the opening.
So these dynamics can continue as long as they continue. I mean, ultimately, the question is are you down to demand? And we don't know that though. I mean, we look at today's report. If we see more like that, we can't know what the future holds. But in the meantime, we've made pretty good progress on inflation with our current stance.
Michael McKee from Bloomberg Radio and Television. The base case of the committee seems to be that there is going to be at least one rate cut this year, but your growth forecast doesn't see any slowdown in the rest of the year, nor does the unemployment forecast see any significant weakening of the labor market. And your inflation forecasts basically average out to no change. So if at the end of the year there is no change from conditions now, why would you anticipate cutting rates? What would be the point for a rate cut?
Well, we think policy is restrictive, and we think ultimately that if you just set policy at a restrictive level, eventually you will see real weakening in the economy. So that's always been the thought, is that since we raised rates this far, we've always been pointing to cuts at a certain point, not to eliminate the possibility of hikes, but no one has that as their base case. So no one on the committee does. That's how we think about it, and that's what we've been getting. That's what we've been getting is good progress on inflation, with growth at a good level, and with a strong labor market. Now, ultimately,
Okay, guys.
we think rates will have to come down to continue to support that.
I think I'm gonna close the live.
So far, they haven't had to. And
you
that's why
want to
we're
ask
watching so
anything
carefully for
else?
signs of weakness. We don't really see that. We kind of see what we wanted to see, which was gradual cooling in demand, gradual rebalancing in the labor market while we're continuing to make progress on inflation. So I mean, we're getting good results here.
Well, to follow up, is there any kind of concern for the housing industry or financial stability banks in leaving rates where they are for too long at this point?
On housing, the housing situation is a complicated one, and you can see that's a place where rates are really having a significant effect. I mean, ultimately, the best thing we can do for the housing market is to bring inflation down so that we can bring rates down so that the housing market can continue to normalize. There will still be a national housing shortage, as there was before the pandemic. There will still be one, but the distortions that we see now with lock-ins and things like that, low mortgages. In terms of banks, the banking system has been, solid, strong.
Solid banking system is strong with 500 billion.
We've seen good performance by the banks. We had the turmoil early last year, but
good.
Banks have been focusing on bringing up their liquidity, bringing up their capital, and having a risk management plans in place. So the banking system, seems to be in good shape.
And here we go for the highs again. The opening range is gold.
Thanks.
Nothing can beat this system. I must patent it and sell it. I'm gonna make millions just from selling
where
this.
you see inflationary pressure in the economy.
You are lucky that you are getting this
labor
for
market's
free.
coming into better balance.
Yeah.
And inflation expectations appear to be well anchored. You're seeing, anecdotal stories of the large chains like Walmart and Target are announcing price cuts.
Imagine to have
announcing a
10,000
$5
viewers.
meal deal.
All those
So
playing the
people may
opening
still
range
be
as
unhappy
well.
about prices at the grocery store.
It
but
will increase
it doesn't seem
the
like there's a lot of
efficacy
inflationary
by
pressure
far.
left in this economy. I wonder if you could tell us more
So
about
I
it.
think it's true that inflationary pressures
Don't
have
forget
come
to leave
down,
a like,
but
guys.
we're still getting high inflation
I
readings.
see
So
25 people
and I
here,
think you can
8
see
likes
in
only.
various places.
You don't like it?
In some parts
I will close it.
of non-housing services, you see elevated inflation still, and that's probably it could be to do with wages. Goods prices have kind of fluctuated. There's been a
Fluctuate.
surprising increase
Okay,
in,
he knows the word
in
how
import
to
prices
pronounce
on
it.
goods,
Fluctuate.
which is kind of
Not
hard to
as Lagarde.
understand.
Fluctuate.
And
The fucking old
we've
lady.
taken some signal
Fluctuate.
from that, but,
Fluctuate. What's fluctuate?
And of course, housing services.
You
You're
stupid
continuing to
bitch.
see high readings
Fluctuate.
there. To some
What
extent,
fluctuate?
That's,
What is fluctuate?
Catch-up
It's
inflation
fluctuate.
from earlier pressures. But I mean, overall, you're right. Inflationary pressures have come down. As I mentioned, the labor market has come into better balance. Wages are still running, I would say, above a sustainable path, which would be that of trend inflation and trend productivity. You're still seeing wage increases moving above that. We haven't thought of wages as being the principal, cause of inflation, but at the same time, getting back to 2%.
I will give
inflation
him a
is likely to
complimentary
require,
subscription to
more
Powell.
return to a more sustainable level, which is somewhat below the current level of increases in the aggregate.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. There's obviously a lot of focus on
Nasdaq
how
won't
many
get
cuts could be
easy
expected
if
this
it
year,
doesn't
but
make
can you
it.
give us a sense of what one cut by the end of the year would actually do to the economy, what you think would be a meaningful difference if there was a cut by the end of the year, or even two?
I think if you look back in 5 or 10 years and try to pull out the significance to the U.S. economy of one 25 basis point rate cut, you'd have quite a job on your hands. So that's not how we look at it. Really the whole rate path matters, and I do continue to think that when we do start to loosen policy, that will show up in a significant loosening in financial market conditions, and the market will price in what it prices in. I have no way of saying
let's see the new
we're
high
not
and
at that
I will
stage, so
close
I
the
don't
line.
know what we'll be thinking about it at that time. But it's a consequential decision for the economy, and you want to get it right. And fortunately, we have a strong economy, and we have the ability to approach this question carefully. And we will approach it carefully while we're very much keeping an eye on downside economic risks should they emerge.
And you've been talking about this clear sense that it's just going to take longer to have the confidence that's needed for rate cuts. Is there something about what happened in the first couple of months of the year that you're seeing differently now with more time or hindsight? Do you still characterize it as expected bumpiness or something more lasting that is affecting your policy for the rest of the year?
You know, we you always want to avoid the tendency to dismiss the parts of inflation that we don't like and just make it go away. So, but we had a quarter where inflation was running higher, and yes, I could stand here and say it's stuff we shouldn't have taken signal from, but it is what it is. You know, you have to, you know, low inflation is low inflation, high inflation. So if you have a quarter where it's higher, we tried not to take signal from the first couple of months, but we got a third month and we said, okay, the signal we're taking is that, you know, we think it's going to take longer to get confidence that inflation is moving sustainably on 2%. That's what we said. I think that was the right thing to do. I still think that's the right thing to do. Now we have today's inflation reading, which is very different, very much more positive. We're going to have to see what the trend is, what's going to be the data going forward. We're looking for something that gives us confidence that inflation is moving sustainably down to 2%. And readings like today's, you know, that's a step in the right direction, but, you know, one reading it's only one reading. You don't want to be too motivated by any single data point.
Until we have a second. Okay.
Hi, Chair Powell. Thank you for taking our questions. I'm Jolene Kent with CBS News. What's your message to Americans who are seeing encouraging economic data but don't feel good about this economy?
I don't think anyone knows, has a definitive answer why people are not as happy about the economy as they might be. And we don't tell people how they should think or feel about the economy. That's not our job. People experience what they experience. All I can tell you is what the data show, which is we've got an economy that's growing at a solid pace. We've got a very strong labor market with unemployment at 4%. It's been a long time since we've had a long stretch of time with unemployment at or below 4%, very long time. We had a period of high inflation. Inflation has come down really significantly, and we're doing everything we can to bring that inflationary episode fully to a halt and fully restore price stability. We're confident that we'll get there. And in the meantime, it's going to be painful for people, but the ultimate pain would be a period of a long period of high inflation. It is people who, lower income people at the margins of the economy who have the worst experience, who experience the most pain from inflation. So, it's for those people, for all Americans, but particularly for those people that we're doing everything we can to bring inflation back down under control.
As just a quick follow-up here, you've indicated one interest rate cut sometime this year, and I know you don't have a crystal ball up there, but a lot of people are watching and see, borrowing money remains very expensive. For everybody who's out there waiting on a rate cut, about when can consumers expect some relief?
Well, I don't have a precise date for you, but what we said is that we want to make sure that we're confident that inflation is actually moving back down to 2%. And when we are,
so after 2
then
years,
we can look at loosening policy. So having that kind of confidence that inflation will be at 2%, it just pays benefits to the whole economy, to all Americans for a long period of time. We had that period for a very long time. We very much want to get back to a place where people can not think about inflation. It's just not a concern in the everyday economic decisions that they make. We were there for a long time, and our goal is to get back to that place. And we've made good progress, and we're in the phase now of just sticking with it until we get it done.
Claire Jones, Financial Times. Just drawing on the change in the statement on there being modest further progress on inflation. Halfway, through the year and after today's CPI release, what have you and other committee members found that has been particularly encouraging to you? And just in terms of the conservatism, how much of that is about stickiness in shelter inflation in particular?
Okay, guys.
So encouraging.
I'm gonna close the live.